I'll start with a fairly quick fire round, if I may, just to get the top line thoughts of the panelists on the exam question. So, global growth, what does it look like next year? What will drive it? Gurpreet, I'll start with you.
Great. I think, first of all, thank you for having me here. It's helpful to status check on where we're coming from and what's the starting point. So first of all, labour markets have rebalanced, inflation has come down, and growth by and large has remained steady. Germany is a notable exception, but the US has been growing above trend. So where to in 2025? I would say there's three key features or elements. You've got divergence, uncertainty, and fiscal. On the sort of divergence front, even if you have limited US policy shifts, we do think that you're going to have more growth divergence. The US going above trend, Europe slightly below trend, facing headwinds from competition from China to its manufacturing sector, trade policy uncertainty. You've also seen subdued consumption there despite real income gains, and then, of course, ongoing challenges in China. But what if we see more material policy shifts? And I'm sure we'll come on to this, but that's where we are focused on the 4 R's of the new US administration: rise in tariffs, reduction in taxation, relaxation in regulations, and any restrictions on immigration. And I think that is going to be creating much more uncertainty in the outcomes ahead. And then last but by no means least, I think we are very focused on fiscal adjustments, of course, in the US, what happens there, but also potentially in Europe. We have an election in Germany in February. We'll have to see if there's any progress on fiscal expansion. Germany, just to put one stat out there, its debt to GDP is 64%. In the US, it's 120%. So if all the major advanced economies, if there's one that has room to engage in fiscal expansion, it is Germany. So to summarize, there is a central scenario where you could still have steady growth, but with divergence, but there is much more uncertainty, and there's definitely downside risks from tariffs.
Alex, perhaps you could pick that.
2010 to 2020 has been all about monetary policy, 2024 inflation, and similarly, 25 onwards is probably going to be fiscal. And which countries can do fiscal? And I agree, it's Germany. The US is going to be touch and go. Trump has got limited room for manoeuvre when it comes to fiscal, and we'll see. There's a sort of view towards the rates market which is quite balanced, which in our view means a lot of volatility on rates, because you can make both arguments, rates up, rates down, and it's just going to be very much, we talked about the unpredictability of Trump, and I think this will be reflected in and is reflected in rates market. Whilst most other markets have reacted generally positive to Trump, but the divergence is definitely one. And I think one point to make about Europe is most investors have written it completely off. Yeah. It's just hated by everybody. But actually the data isn't as bad, and it doesn't really reflect. And yes, you've had France, you've had Germany, but look at, my country, Italy, looks quite stable, which is quite unique. We're not used to this. But I think these sort of Mediterranean countries are feeling slightly better. They've been spending, they've been doing slightly better, and the core Europe is less so. So I think speaking about growth, it's probably going to be not dissimilar to now. And the big divergence is US-Europe. The US growing at 2%, 2.5%, Europe growing maybe at 1%. I don't know, pick a number. But the rates is what really you're going to see most of the pressure on going forward, because of the general uncertainty of what countries can do, and the new politics and the new geopolitics situation.
Well, good. And good. Always good to kick off with a note of cautious optimism. So thanks for that. I mean, from and both Aaron and Niall, you kind of look at what we've just talked about from a kind of a top-down investment view. I mean, perhaps Aaron, if you could pick up on the volatility, the rates environment, and how you're thinking about that from a portfolio perspective.
Well, certainly, I'm the sacrificial American here.
You got the award for most distance traveled to sit on the stage.
Yeah, for sure.
Congratulations.
If I had to sum up our view of the economy for the coming year, I would say it's decent, not too exciting, but it's hard to see real big problems that are brewing. I know there's a lot of concern about tariffs and a lot of changes in politics, so there is some uncertainty out there tied to all of that. But I think another way to maybe spin that, especially from an investment standpoint, is we're coming off a period of exceptionally high uncertainty with tremendous amounts of political change, here in the UK, in the US, in Europe currently. We talked about South Korea. I mean, Japan, complete change in leadership that you haven't seen in decades. So we're coming off some of the most intense political uncertainty we've ever seen. And while there's still some uncertainty ahead of us, I think we're gradually going to get clarity on what policies are going to be put in place and what's actually going to get done politically. And so in some ways you could say, yes, the big uncertain part of the economy in the coming year is politics. But I think you could also argue that that uncertainty is diminishing. So from an investment standpoint, I generally think of that as a positive thing for markets because, markets generally speaking hate uncertainty. They like clarity, and although you might not have perfect clarity, you never really do. But I think people will gradually feel more comfortable, especially as they think about the US elections. I mean, I think there is this knee-jerk reaction in the market. As you said, overall, it's been generally positive so far. But usually that doesn't last very long. I mean, one thing we always say at our firm is presidents aren't kings, and they usually can do a lot less than people hope or fear. So everyone's very worried about Trump and his policies in a Republican sweep. Well, they'll probably be less worried as the year progresses because they come to find out all this is harder to affect than people think it is, and there's a lot of watering down of these policies and so forth. For those very excited about it, they're probably due for a little bit of disappointment here because you can't do as much as expected. So I think the big wild card for the economy, which otherwise seems to be in reasonably good shape to us, and corporate results are certainly good, and you're seeing animal spirits picking up in some areas, and I think that's important for the economy. I think the combination of that with falling political uncertainty overall for markets is probably a pretty good thing.
Well, you've seen Alex's cautious optimism and raised it. So, so Niall, do you want to bring us back down to earth, or?
Well, you asked kind of about portfolio construction in that context. So, I suppose if I think about the challenge that I'm hearing from people as I go around the globe and have the conversations, the first thing is probably just this very simple point of diversification. For a lot of people, they're actually beginning to question the value of diversification because their lived experience is that Wall Street Journal the week before last, talking about a third of your portfolio is not doing its job, was the headline. And they were referring to the overseas equities part of that portfolio. Yeah. So a lot of people are challenging how to have diversification. A lot of people are wondering how they keep it in their portfolios. Indeed, getting people to stick the course with some of the things that should add value in certain cases will be important. And that probably brings back to the context that everyone's making. When a market has been priced for a lot to go right, in that context, the election was very good news. A lot of uncertainty was removed. History suggests a definitive election result and a clean sweep is good for economics. Yeah. But now that we're out the other side of that and you begin to settle, then maybe you'll begin to see the valuations that matter intra-sector. I think the second thing that people are thinking about a lot in this context, you're possibly going to be looking at a very unusual occurrence that for 2 years in a row, the public markets are going to outperform private markets in, say, in equities. People are then going to begin to wonder, well, hold on, what's going on in this part of my portfolio and what does that mean? And that will relate also to private credit opportunities and whether there's too much capital going in or whether there's actually just the start of what is an epoch change as banks adapt to new regulations and the things that come with it. So those three things, and probably something you'll touch on later in your panel on ESG, they're the big questions that we think people are asking in portfolios at the moment.
I mean, I'm sure that all of those points, and particularly your one on private credit, we'll also pick up on the on the private markets panel. And indeed throughout the morning. Obviously you all kind of started with the US election. It's such a sort of a major event in global markets, and obviously we spoke a little with Sir John about it a few moments ago. But we, in advance of this event every year, we do a bit of our own research. We'll have a few statistics throughout the morning that kind of crop up. We spoke to 300 investors globally from sort of meaningful investment houses, 100 in the US, 100 in Europe, and 100 in the UK. And 72% of those told us that despite the positive market reaction to the Republican win, it creates a lot more risk in financial markets, probably as we've already spoken about, owing to Donald Trump's penchant for the unpredictable. Does that suggest to you that the market rally that we've seen on the back of the election result is a bit over exuberant? Maybe, Aaron, because you touched on it, we could start with you.
Well, I think it's important to think about the overall market reaction and then the subcomponents of the market a little bit differently. Because I don't know that the market reaction, first, hasn't been too extreme. I mean, the market's done just fine since then. And I don't think that's overdone. And then I think that's mostly a reaction, as it was said, to an election that went reasonably well. I think leading up to the election, there was a lot of uncertainty about the outcome. It was looking very close. It ended up not being quite as close. There was a lot of worry if things didn't go Trump's way, were we going to get protests and those types of things as we saw last time around. And so I think just getting all of that out of the way decreased a little bit of the uncertainty. So I think that partially is what markets are reacting to, and I think that's appropriate and probably sustainable. I think as you look under the hood of the market and you say, well, what has been doing well and poorly here within the market based on expectations for what the administration may or may not do, there's where I get a little bit more skeptical. And so when I see certain sectors like healthcare selling off a lot because they're worried about, as always happens in U.S. elections, people talk about bringing down healthcare costs and nobody ever does it, but that always causes a little bit of consternation. Or if it's, appointing RFK Jr. to the head of Health and Human Services, which he hasn't been appointed yet, but that's led to some concerns. And so when I see the market or certain elements of the market reacting to expectations for what these policies might be and the impacts they might have, there, I would say that seems probably unsustainable. So I wouldn't read too much into the knee-jerk reactions of the market underneath the surface, but at headline index levels, do I think overall just getting past the election, and is that in many ways supportive of the market in combination with a decent economy and decent corporate results? I think that is sustainable, but I'd be a little bit more suspect about what's going on with specific sectors, or even outside of equities with things like the dollar or interest rates and so forth. I wouldn't expect that these knee-jerk reactions in capital markets are necessarily sustained.
I think the thing I would add to that, I agree with the point, is when you look at things, and focusing on the US for a second, things are clearly a little bit stretched in terms of valuation sense. But the question becomes, if you look at history, we were looking at this a few weeks ago, there have been times where things have been this stretched, if you were to look at the equity risk premium relative to bonds or whatever, where in the following 3 years you had 70% outperformance of equities over bonds. And that is the thing to be wary about. A lot of this boils down to the time scale that you're prepared to live with in terms of underperformance. And in a world where increasingly people are becoming more focused on short-term performance measures, it can be hard for somebody to react against it. What that then suggests is you have to ask yourself, what is the catalyst that would cause this to change? Because if it changed, it could change quite rapidly for the reasons I've just talked about, and also things like algorithmic trading and other things that'll be in the background in those situations. So your point about the risk means that, yes, things could go along for a while, but if it changes, it could be quite violent in those situations. Which brings me back to the point I made a few minutes ago. I think it's a good idea to have diversification in the portfolio, even if it means that, that's the way I sometimes describe it, in diversification you're always a little bit annoyed because you could have done something differently. But better that than being very disappointed.
Yeah. And Alex, I suppose just turning to you for a second, presumably that environment that Niall describes where things can, just because there's an American here, I've sort of overwhelming desire to say like change on a dime, but I don't even think that's the right idiom. Anyway, change very quickly, that must be good for, and you're a highly active management house. You've got long short strategies as well as long only, but kind of conviction moves. I mean, I guess you're probably quite happy that there is an injection of volatility.
I think going back to where we see the risk is very much on rates, as I made the point earlier. Trump 2016 had a very different starting point to Trump 24 in valuation terms, in debt to GDP ratios, in a number of things, which makes his room to maneuver a lot tighter. Now, when I said it's going to be about fiscal, not just in America, but everywhere, that is where the risk is going to come from. If you look at the yield curve in the US, there's no term premium of moving out. The 2-10-year really has nothing built into it. If you look at the equity risk premium, again, it's as Niall was saying, it's at a very extreme situation. So on a valuation basis, on top of the economy, you've got a very different starting point. Hence the discomfort that a lot of your panels and investors have been airing. Now, I agree with Niall. It could be irrational for much longer, as we've seen in other bubbles. And nobody's used the term bubble still, but I think it's probably we can start to think of it as a bubble. Now, when does it burst? It could be. I was just telling the panel before coming in, I've been called a dinosaur because I'd rather go for income rather than buying growth at 40 times earnings. But in talking with American investors, they say, well, Alex, we do growth, we don't do income, and hence we are where we are. And when will that turn round? It's been 15 years plus since Lehman that people have been going for growth and not for income. It's a different world. So is this a generational shift? Is this a paradigm shift? I don't know. I feel comfortable when I get my dividend paid into my account. I can pay school fees, but you certainly have a lot of investment strategies based on growth.
Yeah, from the macro to the micro and back again. Gurpreet, if I could perhaps come to you. And obviously, one of the big risks, and we've mentioned it a couple of times, I'm sure it will come up again and again, is on trade tariffs. And if we were to get the undiluted version of what Donald Trump sort of campaigned on vis-a-vis tariffs, if that were to happen, what is the impact on the US? What is the impact globally? And I guess a sub-question, how likely is it that we'll get the undiluted version?
Well, I think before I go into that, maybe I can just pick up on some of the points that were made and add credit into the mix there. So one of the questions that we often get asked is, spreads are so tight, but coming back to the point about income, we will emphasise, but your income potential is the highest that it's been in over a decade. And spreads are tight for a reason. Look at credit fundamentals. Higher rates have instilled discipline amongst company management teams. They've been managing their balance sheets well. We like that as credit investors. It's good for you. And so I think the key thing to watch from that standpoint is whether the relaxation in regulations that I mentioned, that leads to a revival of animal spirits, a pickup in M&A activity. For now, it's being funded with cash and equity, and that's bondholder friendly. But do you start to see an increase in debt-funded M&A activity? So that's something to just put in the mix. And also on the point about spreads can stay tight for long, similar to equity valuations. Look at the period from 2004 to 2007. You had tight spreads. You had that in the mid-90s. We actually seem in a comparable period to the mid-90s when you had a Fed hiking cycle that managed to engineer a soft landing and then steady easing. So just to put that out there. On the tariff risk, this is one of the primary risks to the global economy if you were to see sizable tariffs. I think for the US, what you have to take into consideration is, it's a one-off hit to consumer spending. It's a consumption tax that can weigh on growth, and obviously it's also going to drive consumer prices higher. Look at the 2018-19 experience. We saw that companies mostly passed on those higher prices. And I think what is key to then understanding how does this reverberate globally is clearly there are more material implications for export-led economies, for Europe, China, and so forth. But you also need to take into consideration, what is the offsetting fiscal response? Does this necessitate fiscal response in Europe? Does that help to buffer that? Also take into consideration, is this the start of a more material escalation in trade tensions? Does it accelerate the process of deglobalization? In which point it might actually be an impact for the supply side of the economy, supply chain disruptions. And that complicates how central banks can respond as well. I think one thing that is different to maybe years gone by is we often spoke about the effective lower bound on interest rates. Central banks do today have room to cut rates to support the economy. The key topic is really the effective upper bound on fiscal metrics, which we spoke about. So I think it's hard to see how all of that plays out, but those are some of the things to take into consideration. What is the fiscal offset? Is this sustained tariff increases? Is it a demand shock? Is it a supply shock? And that's going to determine the central bank response.
And are you expecting? A fully undiluted version, 80% version, 50%? What's the consensus within Goldman in terms of where we'll land? I know predicting the future, particularly when Donald Trump is involved, is not always that easy. So,
yeah, I would emphasize it's highly uncertain. I would say there is a central scenario where we do expect the targeted tariffs, that is like we just heard on the first panel, highly likely. I think the implications of broad-based tariffs, it might not come initially. There might be some bargaining and to think about with that. It also might take into consideration how is tariff policy paired with fiscal policy, considering tariff revenues to fund some of the fiscal measures. So I think there's lots of things to consider.
Niall?
Yeah, it's funny. A quote that I found just ahead of today, and I just thought it was relevant given what was said, but it was by President Clinton in '98 to the IMF. And what he said was, if citizens tire of waiting for democracy and free markets to deliver a better life for them and their children, there's a risk that democracy and free markets, instead of continuing to thrive together, will shrivel together. In the first panel, we heard a lot about democracy, and now I think we're having the second part of this about free markets. And I think there's something we've learned in the last year, which will spill over to this tariffs point as well, which is the way the people, and particularly look at the voting patterns of who voted where, 50,000 or 50,000 a year less, 100,000 a year, lived, and look at incumbents all around the world losing. Inflation was a massive story, and inflation affects the economy the way we think it does, but it affects people in a different way. And that was, they saw prices go up, they're still up, and they stayed up. And the interesting thing about the tariffs is I couldn't agree more. It's like a one-off tax, but it's a very regressive tax, hitting exactly the constituency that were the people who are behind the Trump in that particular case. So it'll be fascinating to see how that plays out, because if it goes from saber rattling to the fully version that you talked about, I think we would look at this and from the economic lens and say, oh, it's a one-off shock, it won't reset inflation expectations, it'll be a thing. But for the people who live it, it'll be very, very different. And I think it'll spill over to continued political instability and then regime turnover that will happen in the back of it. So I think that the people in charge know that and will have that in the back of their head as well.
See you nodding along there. Alex, anything to add on that?
Well, I think in terms of tariffs, we've had a bit of an experiment in first Trump when 2018 tariffs came up, and there's very mixed results on how tariffs did actually impact the US. Was it beneficial in protecting jobs or not? And I think the jury is still very much out on that. So, I agree with Sir John. There's a lot of saber rattling going on. He likes to be unpredictable, and I think it scares a lot of other countries, and we've seen, people going to Trump and sort of bending down on one knee and saying, "Don't do it, please." So,
which I think is exactly what he wants.
Yeah,
right? I mean, that is what Trump does. He is intentionally unpredictable, and the way he negotiates is to be very extreme, and then hopefully get to a point that's more in his favor than others' favor. And so, like all of us, I don't think I know at all what the tariff situation will end up looking like. But I wouldn't necessarily just assume it's going to be what was promised on the campaign trail. No U.S. politician ever lives up to their campaign promises, and I don't expect that Trump will either. And despite all the desires to drain the swamp in Washington, believe it or not, it's still pretty swampy. And so all of this is a big negotiation, I think. I mean, there are senators from many states who don't want big tariffs, who are selling agriculture and so forth. And it's always a quid pro quo. And so if Trump, which, as we all know, can do a lot with tariffs on his own without the approval of Congress, other things he wants to get done do require the approval of Congress. And so it wouldn't surprise me at all with the very slim lead in the House and the Senate to have certain representatives or senators say, well, if you're going to do with tariffs, I'm not going to go for your tax plan, or I'm not going to go for other things that you want to accomplish. He can't afford a lot of defectors within the party at this point. And so I think all of this will involve a big negotiation, which, if I'm guessing, would mean that you probably get some lesser version of what's been proposed so far. I don't know that for sure, of course, but I'd say that would be my expectation.
I'm keen to leave time for questions, and I've got two final questions. First, one of the less predictable things might be around the Fed and post Powell, who might be the chair, and one, I'm interested in the runners and riders, but also specifically if you think there is a high risk that the next Fed chair could be less independent under a Trump administration, and if that poses its own risk. So maybe Niall, come to you on that.
Yeah, I could spend hours on this literally, but I won't.
We've got 3 minutes.
Yeah, I'll do. Good point. I think there's two major things that matter in the context of this. So one is exactly, you talked about independence. In central bank school, there's two pictures on the wall. There's Arthur Burns and there's Paul Volcker. And don't do that, do that, right? And the danger is Burns was caught by a very close connection to the president that was there at the time, and he felt he needed support. The key question is going to be, implicit in a lot of things we're talking about is the threat of inflation coming again.
Mm-hmm.
In that situation, a central banker needs to have the ability to act freely. If the appointment that goes in doesn't, then the parallels that are already there between the 70s and this decade could see themselves again. So I think it's very important that the person that goes in has the ability to do it. There's a second, though, one that I think is really important to think about, and it was in your comment earlier on credit as well.
Mm-hmm.
There has been a central bank put hanging around for a long time, but perhaps not the way we think. It's to do with the leveraged financial system. Whenever the leveraged financial system comes into threat, the central bankers act. You saw it in the gilts crisis, you saw it Silicon Valley Bank, you saw it in all.
Yeah.
It's a leveraged system. It has to be kept going. Whoever they put into that role has to be savvy enough to understand those things, because if you start playing fast and loose in those situations, as was learned a few years ago in the gilts crisis, things can get very, very bad very quickly.
Yeah.
All of those things lead me to believe that I doubt if he would be very cavalier with the appointment. It might be more somebody like the SEC appointment today, which was somebody from the Bush SEC. He will talk a good game, but this is dancing on the precipice if you're not careful.
Anyone want to?
Yeah, I
Gurpreet?
would just add to tie up to some of the points made on the first discussion. When you have political change, you do have these independent institutions that have processes in place to protect that independence. The FOMC is 12 members, 9 Fed board members are composed on that. The board members serve 14-year staggered terms, and so that is designed that the president can only ever appoint 2 new board members. And so we know that Chair Powell's term ends in May 26. There's another board member whose term ends in 26 as well. But also each voting member's vote carries equal weight. So I think you're not necessarily going to see a significant shift in policy based on 2 appointments alone. And those institutional frameworks and structures are designed to sort of outlive political cycles.
Well, in a desperate attempt to hunt for some optimism here, for my final question, I'm going to sort of gratuitously try to lead the witnesses by saying that another stat that I wanted to throw out from our research was that 85% of investors, overwhelming majority, thought that the Labour government would be supportive of UK assets, which is a screaming buy signal, if ever there was one. I should mention that the poll took place post Rachel Reeves's budget, but pre Mansion House. So just with that context in mind, the final quick-fire question, we'll come to Alex first, and then Niall, then Aaron, then Gurpreet, is in 2025, pick one asset class that you like and one asset class that you don't like very much. Is it UK equities?
Tempted, but no, I'll diversify.
Right. Yeah.
We like banks. We like the whole capital stack of banks. As long as the dividend yield is 3 times the market, you're getting between 9 and 12% dividend yield on European banks versus the market that's giving you around the 3-4% dividend yield. And then when you look at sort of the credit of banks, we are specialised in additional tier ones, you're getting nearly twice the spread that you get on high yield. Those high yield companies that the same banks can't lend to. So you've got, I think, a clear valuation advantage there. And as long as additional tier ones are wider than high yield paper, I think that's compelling. And as long as again, I made the point about income. As long as your dividend yield is 3 times the dividend yield of markets, I think there's value in that. And the situation for banks is so much better than it was pre-Lehman or around Lehman. It's been 15 years of bear market in banks. And I think there's still muscle memory against the sector, but the sector is definitely back, we think.
And one to avoid?
Bitcoin.
Niall?
I suppose you always ask the person not what would they say, but what are they actually doing. So if
Yeah.
we look at our own portfolios, we're kind of, in a lot of the equity context, boringly neutral at the moment. And so we see it two-sided as well. I would say the overweight and underweight. So the biggest overweight we have at the moment is actually a position in frontier market debt. I
Right.
think that there's a genuinely high source of return, a diversification, a lack of understanding that leads to opportunities. And while we're not necessarily thinking there's going to be a credit crisis for all the reasons laid out earlier, we think the starting point in spreads in high yield is probably quite tight
Right.
for a lot to go right. So we're tending to be underweight those and overweight the frontier.
Aaron?
Well, you're not going to get a totally unbiased opinion here as a long equity manager. You'll be incredibly surprised to hear we like equities in the coming year.
UK equities? Or?
I think the tricky part about UK equities, relating it back to the Labour Party, is that at least the bigger parts of UK equity markets aren't all that exposed to the UK. Big multinational pharmaceutical and consumer staples and energy firms. And so do I think the new government will be supportive of UK assets? I really think they're more tied into the global economy.
Yeah.
And so really it comes down to, do you like those sectors more than do you like the UK or not from a purely economic standpoint. But we do see a good backdrop for equities. I don't want to get over my skis here. I do see some risks out there as well. And we're certainly not anticipating yet another year like we've had over the course of the last two. But I think on the back of decent corporate fundamentals, yes, high valuations, but I think still a lot of skepticism about the economy. I mean, you look over the summer and all it took was one or two bad labor numbers to all of a sudden get recession fears cropping up again. I don't think people are feeling perfectly comfortable with politics or the state of the economy, so certainly there's room for that to improve as well. And maybe, as we said before, with political uncertainty falling a bit, I think all of that adds up to a generally pretty good environment for capital markets generally. I think it's a particularly good environment for equities, just given how strong corporate results are seeming right now, and we are a little bit cautious about valuations, but as said, high valuations can last for quite a long time, and so I think this should be a generally pretty good year for capital markets generally, and particularly for equities.
Gurpreet, final word?
I'm going to also mirror and say the two ideas based on how we're positioned. So we see continued strength and value in securitized sectors. One area in particular, commercial mortgage-backed securities. These assets have weakened last year when people were concerned about commercial real estate, particularly office real estate with rising vacancies, the shift to remote work, etc. But as an active investor, we know that not all real estate is created equal, not all office commercial real estate is created equal either, so you can find some interesting opportunities there. And then in terms of where we think we could see underperformance, it's Japanese government bonds. All G10 central banks are set to cut rates next year, with the exception of the Bank of Japan, a real twist of fortunes relative to the last cycle. And so we've seen 2 hikes this year. We think it's plausible you could see another hike this month, so further hikes in Japan, underperformance in Japanese government bonds.
Thank you all. We've got a few minutes for questions before we have to wrap up, so and go to the next panel. So any questions? Yes. Sorry, I'm staring into a light. So Stephen, yeah.
It's quite strong.
Yeah, it is. Yeah, it's like Good Morning Vietnam. So, yeah.
Thank you. Stephen Clapham from Behind the Balance Sheet. Everybody thinks the dollar is going to go up. Is that right? And where might it stop?
Who wants to take that one? Niall?
I'll start. Basically that's the counterpoint of tariffs. So the obvious example, we talked about China earlier on, is if we see that move on the tariff side, the reaction and responses on the currency side, in a sense that might lead us to when things would stop. In other words, if we were to get to a point where we were to see the resolution saber rattling, not moving to big tariffs, well, that would automatically then mean that there wouldn't be the need for necessarily the devaluations elsewhere, and so the dollar strength could weaken. So in a sense, I think a lot of the dollar positioning at the moment is a hedge against what might be a fear on the tariff side.
Sorry, was the question, everybody seems to think the dollar will go higher.
Yeah.
Yeah, I think that's fair. Like, look at the economic fundamentals, you're seeing US exceptionalism, and then at the same time, the dollar also benefits from its perceived safe haven status. So you do have the risk of geopolitics and tariffs and all of those things lingering. Those all do point to a stronger dollar.
Any other questions from the crowd? Again, I actually can't see you because so maybe you'll have to. Yep.
Hi there, Ian Smith, Financial Times. Just wanted to ask about economic growth outlook for Europe. Obviously, we've seen a big divergence in interest rate expectations because of the anticipation of the tariff policies you've mentioned. Is the market now too bearish on European growth?
I'm happy to start with that, and others can chime in. So I would say, the outlook for Europe does look weak. What's interesting is that we expected this time last year real income gains to drive consumption, but we've seen that those income gains have been directed to savings in Europe rather than spending. So you've seen some caution there. You then have trade policy uncertainty, which is elevated. Even before you get any change in US tariffs, we know that that uncertainty can weigh on business investment. You then have political uncertainty in France and Germany. And what's unique is that at this juncture, you have the two largest economies that are actually experiencing weakness and political uncertainty. But if you look at Portugal, Spain, and other countries, smaller peripheral economies are actually doing very well. So when I spoke about growth divergence at the outset, that was both between big countries, but also within regions.
And Alex, I'm far from suggesting Italy is peripheral, but you could also pick up on that note because you were quite pro at the beginning of this discussion.
Yeah, I think there's divergence within Europe. You've got France and Germany got themselves in a political pickle, like we're saying, Spain, Italy, even Greece are doing rather well. The question is, will the elections be an opportunity for fiscal? And again, we go back there. The French government fell on fiscal, essentially, and so until that unwinds, or we'll see how it works out. But yeah, there's certainly a US premium on growth, and Europe is at a discount. And then again, going back to sort of the dollar question, there's certainly, there seems to be a divergence in interest rates as well, whilst the US is probably going to be, let's wait and see what happens. In Europe, there's probably going to be more supportive monetary policy, at least the market seems to think so. Where it lands at the end of 2025, expectations have moved around 200 basis points lower in rates in Europe, hence the strength of the dollar. Whether that's the case or not will probably depend very much on the path of France and Germany.
Sorry. Go on.
I was just going to say, I think the way the question was phrased is important too, because are expectations too low? I think maybe. I think there are some parallels to what we saw coming out of the 2016 election, almost eerily so. You had a Trump win, you had Republicans take over, you had a lot of fear in the Eurozone, you had Marine Le Pen's party gaining a lot of prominence in France. All of that is going on here today as well. And I think all of that is reflected in a lot of skepticism and negativity towards European assets. And so, are we expecting phenomenal things out of the European economy? Not necessarily, although there's weaker and stronger parts, but it's hard to argue that a lot of that negativity isn't already reflected in asset pricing there. And so, maybe a little more of an investment case and less of a pure economic case. I do think there's something compelling about European assets and equities in particular, just given the fact that nobody can see, and that's the 30% that everybody hates in their portfolio for a long time, right? And, I think that all the negativity already being reflected there does leave a little bit of potential for upside surprise.
Well, it's a good place to leave it there because it's, again, thank you for another upbeat note. And obviously the next panel that we're going to hand over to you is all about sort of all the bad stuff. So we'll very quickly deflate that balloon, but could everyone just join me in saying thanks to the panelists?